Okay, Chapter 13, Risk, Cost of Capital, and Valuation. So, concepts and skills. We're going to determine a firm's cost of equity capital. We're going to talk about beta and how we're going to use that to calculate the firm's cost of equity capital. Determine the overall cost of capital. So overall cost of capital is going to be a function of the cost of equity capital, the cost of debt. Debt we'll have to do on an after-tax basis. And then in some cases, we may have preferred stock figured in there as well. So, and then we're going to talk about the impact of flotation costs on capital budgeting, and particularly on the cost of capital. So, chapter outline: cost of capital, estimating cost of equity capital using the CAPM, estimating beta, determinants of beta. Then we'll talk about the dividend discount model approach. So this we can use the capital asset pricing model, or we can use the dividend discount model to determine the cost of equity capital. So cost of capital for divisions and projects, fixed income securities, debt. The weighted average cost of capital. So how do we combine all this together to come up with one cost of capital for the firm? Then valuation with the weighted average cost of capital. Then we'll finish up with Eastman Chemical's cost of capital as a case study. So flotation costs with and the weighted average cost of capital, as we mentioned previously. So where do we stand? So what have we talked about previously? Our chapters on capital budgeting, we focus on the appropriate size and timing of cash flows. This chapter is going to discuss the appropriate discount rate when cash flows are risky. So all cash flows are risky, so we have to determine which rate is appropriate. So the firm's cost of capital is a function of the projects available to them. So the firm when a firm has excess cash flow, they can either pay a dividend or they can make an investment. If they make an investment, they have a pretty good idea what they expect the return on that investment to be. Well, on the other hand, when if they pay a dividend, the shareholder has the opportunity to invest the money. So this is why previously we calculated IRRs and NPVs based on a cost of capital. If that cost of capital or the return on a project is less than that cost of capital, they would be better off by paying the shareholder a dividend, because they have the opportunity to reinvest that money. So since they have the opportunity to invest, we need to use that appropriate discount rate. So cost of capital from a CAPM perspective. So the CAPM, we use the estimated return is cost of equity capital is the return determined by the CAPM. So that return would be the risk-free rate plus that firm's beta multiplied by the market risk premium, the expected return on the market minus the risk-free rate. So to estimate the cost of capital, we need three things: the risk-free rate, the market risk premium, and the company's beta, which is determined by the covariance of the return on the asset and the return on the market, divided by the variance for the return on the market. So, and notation form sigma IM divided by sigma squared for the market. Example here. So we've got Stansfield Enterpriser as a publisher of online presentation, has a beta 1.5, and the firm's 100% equity finance. So in that case, the cost of equity capital is going to be the cost of capital for the firm. So we have a risk-free rate of 3% and a market risk premium of 7%. So what's the appropriate discount rate? So we're going to employ the CAPM. So the appropriate discount rate for this firm would be the risk-free rate, 3%, plus the beta of 1.5 multiplied by the market risk premium of 7%. And you get 13.5%. So, next example. So, suppose Stansfield Enterprises is valuing the following independent projects that each costs $100 and last 1 year. So the project A has a beta of 1.5, and the estimated cash flows next year $125. That means the IRR is 25%, and PV is $10.13. Project B is 113.5. If you recall, our cost of equity capital was 13.5%. So the NPV is 0. So in C, the project cash flow $105. The IRR on that project is 5%. So we have a negative NPV. So we go look at it based on the security market line. So we'd have project A up at the top, B in the middle, and C. So we've got the IRR on the y-axis and the beta on the x-axis, as we always will. And so the security market line is going to go through project B. So we would accept project A and B and reject project C. So we will continue with the discussion of the risk-free rate in the next lecture.